Mike Lenhoff, Chief Strategist and Head of Research at Brewin Dolphin Securities. Hi, Mike.
Morning.
I mean, the message from banks this quarter is a positive one. They've pretty much all beaten or met expectations, haven't they, Mike, on both sides of the Atlantic. Investment banking was the iffy side of things, but on a net income front, on an earnings per share front, they beat estimates, didn't they?
They have. I mean, the picture's been a little mixed. Some have done a little better than others, but on the whole, it's been a very welcome event and hopefully indicative of more promising times to come for them. But I think overall, it's very much still a more top-down call for the banks. You mentioned the regulatory environment. That's going to provide constant pressure on the banks through time. But I think the big deal for them really is, you know, is there going to be a double dip? I don't think there is, but, you know, there will be this concern. And, you know, the pace of the recovery. Can it be sustained? Has there been enough stimulus pumped into the system? And so on. And I think that will overhang the banks.
What sort of pace of recovery, Mike, are we looking at? I mean, Stiglitz, the Nobel laureate, former laureate, calls it anemic. Is that how you'd categorize the recovery? Yeah,
I mean, I think it was generally expected it would be a very slow, a very uneven and very difficult sort of recovery. And we hear the same terminology used by everybody, you know, unusually uncertain times and so on. It is anemic if you look at the jobs. You know, the response of the labor market to the growth.
And today
has been coming through, and we'll see what happens today. So I think that everybody would feel a lot happier if we could see the job market improve, because I think that would be indicative of whether we're going to see a sustained recovery. I think that's how you would judge whether or not the recovery is sustainable, by the generation of jobs. And although companies, including the banks, have been generating great profits, what's happened is they've been going for the productivity. They've been trying to get more output for the same sort of labor force and not really looking to acquire. Now, with this profits come investment, and that's what we're starting to get. That's the good bit in this overall anemic sort of background. But if you look at what's happening, particularly in the States, investment is starting to pick up. And with investment will sooner or later come the jobs. So, you know, I think we have to give it a chance, give it a bit of time.
What about the markets, Mike? I mean, 3-month highs for many of the indices. Time to buy, or is this a nervy time if you're an investor?
I think it's just, you know, it's a very difficult. What we've seen is a lot of volatility this year, and it's been very much associated with the behavior of the banks, talking about them earlier. And I suspect that's the way it's going to be for the balance of the year. So, you know, the issue is, yes, can we make some money, but more importantly, can we make sure we don't lose too much? And therefore, I think that, yeah, there is a lot of value in the markets. The sort of thing that we've been looking for is yield, the more defensive growth areas of the market, because we think that's really where it's at. And also, I think the sort of dollar play type earners in the emerging markets.
Got to move it on, Mike, but thank you very much indeed. Mike there from Brewin Dolphin. Mike.